All right, let's talk mortgages. When you're shopping for one, it's so easy to think, the rates are all going to be about the same, right? Maybe a tiny difference here or there. But what if I told you that one little assumption could be costing you literally tens of thousands of dollars? Today, we are pulling back the curtain on the real price of your mortgage.
Now look at this. This isn't some made-up example. This is a real quote from a real person. A 1.5% difference on a home loan, that is absolutely gigantic. We're not talking about a few bucks. We're talking hundreds of dollars every single month for 30 years.
And yeah, that's the big question, isn't it? How on earth can two places offer the exact same thing, the same loan, at such wildly different prices? You know, it's like one store selling a gallon of milk for $3, and the store right next door is selling it for $5. It just doesn't make any sense.
So, let's get into it. Let's solve this mortgage rate mystery together. We're going to break down exactly what's going on behind the scenes that creates these huge, and I mean huge, differences in price.
Okay, so here's the first thing that might surprise you. In the US, most mortgages are basically the same. They're standardized products. And why is that? Well, it's because the government ends up buying almost all of them. And for that to happen, the loans have to fit into a very specific uniform box.
The best way to think about it is like this. It's like buying a generic medicine versus the big-name brand one. The actual product inside, the thing that does the work, that's identical. The loan is the loan. What's different is just the packaging, the marketing, and of course, a very, very different price.
So if the product is the same, why the different price tag? What are you actually paying for with that higher rate? Because I'll tell you, it's not for a better mortgage. It's for something else entirely, hidden in the cost.
And here it is. Big banks spent billions with a B on advertising. You see the Super Bowl ads, you get the fancy mailers, you see the online banners everywhere. Well, that money has to come from somewhere. And a lot of the time, it comes from you, baked right into your interest rate. Credit unions, on the other hand, are a different story. They're nonprofits. They don't have giant marketing departments to fund, so they don't have to pass those costs on to you.
So the next time you get one of those exclusive, pre-approved offers, just think about what it really is. It's that massive marketing budget at work. And more than that, it's a bet. The bank is literally betting that their fancy packaging and their brand name is enough to make you stop looking for a better deal.
This leads us straight to the alternative, the credit union. Their whole business model is just built differently, from the ground up. And that fundamental difference is exactly where you can find some serious savings. So let's be super clear on what a credit union actually is. It's a nonprofit, and get this, it's owned by its members. That means if you bank there, you're an owner. Their whole goal isn't to make money for stockholders. It's to provide good value to the people who actually use their services. And that changes the entire game. And hey, the proof is right here in the numbers. At the time of this data, the best rate from a credit union was 74 basis points lower than the national average. Basis points is just a fancy Wall Street way of saying 1/100%. So we're talking about almost 0.75% lower. On a, say, $400,000 loan, that's thousands of dollars in savings every single year. It's huge. Now, of course, this isn't to say a credit union is the perfect choice for absolutely everyone all the time. To be a really smart shopper, you've got to know the trade-offs. Okay, let's look at this side by side. Big banks, yeah, they often have higher rates, but they might be able to close your loan a little faster, which could matter in a hot housing market. And their apps might be a bit slicker. But check out that last row. Here's the dirty little secret of the industry. Both big banks and credit unions can and often do sell your mortgage to another company to handle the payments. So that amazing app you signed up for, you might not even end up using it.
Okay, so you've got the knowledge. You know the secret. Now, what do you actually do about it? It's pretty simple. Here's a 3-step action plan to make sure you get the best deal possible.
First, and this is the most important thing you can do, compare multiple lenders. Do not just take the first offer from your main bank. Look at credit unions, look at smaller local lenders. Second, here's a great pro tip. Before you even start applying, go to optoutprescreen.com. It's a free service that stops lenders from flooding your mailbox. And finally, remember to get personalized quotes. Those rates you see advertised are just a starting point. Your real rate depends on your credit, your down payment, all that stuff.
At the end of the day, just knowing how this game is played gives you a massive, massive advantage. In the mortgage world, knowledge isn't just power, it's real money in your pocket.
So I'll just leave you with this one question to think about. Now that you know the secret, the next time you see a mortgage offer, ask yourself, what am I really paying for here? Am I paying for the loan itself, or am I paying for that bank's next big TV commercial? Now you know, the choice is yours.